Welcome to Real Estate of Mind. If you enjoy the content, please don't forget to like and subscribe. Let's get started with today's topic, the capitalization rate. So let's start off with why we need to know what a cap rate is. A cap rate is the most common way to compare real estate assets, particularly in commercial real estate. It's a snapshot in time of a commercial real estate asset's return. According to Investopedia, the capitalization rate, aka the cap rate, is a return metric used in the world of commercial real estate for the rate of return expected to be generated on a real estate investment property. Also note that the cap rate can also be referred to as the yield. It is calculated using the expected net income of the property and dividing the net operating income by the property's value. Commercial real estate is an investment type, so the return is a reflection of the risk and the quality of the investment. It is stated as a percentage. The cap rate estimates the investor's potential return on their real estate investment. The cap rate simply represents the yield of a property across 1 year, but assuming that the property is bought through pure cash and without any debt. The cap rate indicates the property's unlevered rate of return. The cap rate is most useful in a market where sales occur often and buyers can use comparable sales of assets that have tenants in to compare and determine if the price being offered to buy the property is reasonable relative to other sales. Cap rates are commonly used by real estate professionals because they are an easy and quick way to calculate value. However, although cap rates may be a useful measure to compare relative values of similar property investments in the market, it cannot be the only metric to compare an investment. The reason is because it doesn't account for the debts used, the time value of money, any cash flows after improving the property, and much more. A cap rate should only be compared against other cap rates. There is no good or bad range, as cap rates are dependent on the area of the property and how the market is holding up. Now we will take an example. An investor has £1 million to spend. They are considering investing in either A, government-issued bonds offering a 3% annual interest, which is considered one of the safest investments, or B, a commercial building with multiple tenants who will pay a regular rent. In the investment B option, we assume the net income from the property is $70,000. We assume that in the first year, the value of the property stays at the price it was bought for, of £1 million. In this example, the cap rate is £70,000 divided by £1 million, which gives you 7%. This 7% return generated from the real estate investment is much better than the 3% the investor would have got with option A, the risk-free government bond. The extra 4% return represents the risk taken by the investor by investing in the property market, as opposed to investing in a safe treasury bond with absolutely no risk. This demonstrates the riskiness of property investment. So to summarise, the cap rate indicates the property's unlevered rate of return as a percentage. It can also be referred to as the yield. Please don't forget to like and subscribe. If you would like to check out previous videos, please see them on the screen below. Thanks for watching this video.